Welcome. In this video, what happens in the future if we buy XCN with $2,000? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand.
But first, let's analyze the XCN.
A falling trend structure represents market behavior in which the price continues to form lower highs and lower lows over a certain period of time. This structure generally indicates that sellers are more dominant, supply remains above demand, and the price continues its downward momentum. However, this trend line reflects not only past price movements, but also the psychological state of the market. When each new high stays below the previous one, market participants tend to believe that this movement will continue, becoming more cautious about buying, while sellers are inclined to sell their assets even with small upward moves. Thus, the falling trend becomes a self-sustaining structure. However, trend lines do not last forever. At some point, the balance between supply and demand begins to change. Buyers become more aggressive, and when the price breaks above this falling trend line, there is a significant shift in market psychology. From a technical analysis perspective, the break of a falling trend does not only mean moving above a line, it also indicates that selling pressure in the market is weakening, buyers are gaining strength, and a new price direction is beginning to form. This breakout is often considered the start of an attack by investors because with the upward break of the trend, the potential for rapid and sharp price movements increases. The main reason for this is that the falling trend has suppressed buying appetite for a long time. When the price breaks the trend line, this suppressed demand can suddenly enter the market, causing the price to accelerate sharply upward. If there is an increase in volume during the breakout, it is a strong sign that buyers are truly stepping in and that the likelihood of the uptrend continuing has increased. From a psychological perspective, breaking a falling trend restores investor confidence. A long period of continuous price declines creates pessimism among many investors and delays buying decisions. However, when the trend line is broken upward, this pessimism turns into optimism. Especially technical traders see such a breakout as a buying opportunity, which increases market participation. This can trigger the price to rise faster and stronger. The rally following the breakout attracts both short-term traders and long-term investors. At this stage, price movements also encourage investors who previously did not dare to buy to re-enter, creating additional buying pressure that supports the price. Of course, not every falling trend breakout necessarily leads to continued price increases. However, after a successful breakout, a short-term rally is often observed. This rally can push the price rapidly toward previous resistance zones. For example, areas where the price previously encountered repeated selling become target levels after the breakout. If these resistance levels are also broken with strong volume, the potential for the price to move to much higher levels emerges. Strong volume during the breakout shows that market players take this move seriously, which increases the sustainability of the uptrend. Breaking a falling trend has a stronger impact, especially when the trend has lasted for a long time. This is because prolonged declines reinforce the perception that the price is very cheap. When this perception combines with the breakout, both technical and fundamental investors start to expect a price increase. In addition, a falling trend breakout is often seen as a trend reversal signal, leading investors to change their strategies. Traders who opened short positions before the breakout close their positions to avoid losses, creating additional buying pressure. Thus, the breakout moment generates a double upward momentum, new buyers entering the market and former sellers closing positions. The attack that begins with the break of a falling trend line typically reaches short-term targets in the first stage. However, one of the most important factors to watch in this process is that the price does not fall back below the trend line after the breakout. If this happens, the breakout is called a false breakout and can cause disappointment for buyers. Therefore, for a healthy uptrend to continue, the price must stay above the trend line after the breakout. Mild pullbacks after the breakout are usually considered as pullbacks and provide an opportunity for investors to find safer entry points. If the trend line acts as support during the pullback, it is a strong indication that the uptrend could be sustainable. In technical analysis, falling trend breakouts are often accompanied by a trend reversal formation. For example, patterns such as double bottoms, inverted head and shoulders, or symmetrical triangles can be completed with the break of a falling trend. In such cases, post-breakout targets are determined not only according to the break of the trend line, but also based on the technical targets of the pattern. This allows for a clear view of the potential price movement range. If the breakout is supported by a strong formation, the rally can be much sharper and faster. A falling trend breakout is often a turning point for the market. This breakout can be significant not only from a technical standpoint, but also from a fundamental analysis perspective. Sometimes prolonged declines are due to negative news flow or weak market conditions. But when these negative factors begin to fade and the price breaks the trend line, it can also signal that the market is fundamentally improving. This makes the technical breakout more reliable. In conclusion, an attack starting with the break of a falling trend line is one of the most closely watched opportunities in technical analysis. This is because it shows that the balance of power in the market has shifted from sellers to buyers, psychological barriers have been overcome, and the probability of the price starting a new upward journey has increased. Post-breakout buying demand can quickly carry the price to important resistance levels, and if these levels are surpassed, the uptrend can spread to a much broader range. A breakout supported by volume, strong, and sustainable can be a signal of a long-term trend reversal for investors. Therefore, breaking a falling trend should not be seen merely as crossing a line, but as a profound change in market sentiment. But we can't base analysis decisions solely on trends. Let's take a look at other metrics as well. Stay tuned.
In Elliott wave theory, the third wave is generally known as the strongest, steepest, and most attention-grabbing wave for investors. This wave represents the new momentum the market gains after a previous period of decline or sideways movement. If the price has entered the third wave phase, and this wave has reached the 2.272 Fibonacci extension level, it is often seen as proof of a strong trend. This is because Fibonacci extension levels are frequently used tools in predicting wave targets, and the 2.272 level shows that the wavelength has extended beyond an average rise. In the scenario described here, the price reaching the 11-cent level indicates that the third wave has matured and that this rise is not just a coincidence, but the result of a strong technical structure. Reaching this point often increases investor confidence and attracts more buyers into the market. There are several reasons why the third wave progresses so strongly. First, during the first two waves, investors are still unsure of the market's direction. When the first wave begins, it is usually interpreted as the start of a new trend, but many people think it could just be a temporary move. In the second wave, prices pull back somewhat, bringing profit-taking and hesitation. However, when the third wave begins, prices start to rise rapidly, and this rally prompts investors who were watching the first two waves to enter the market with more confidence. Reaching the 2.272 Fibonacci extension level in particular shows just how strong the momentum of the rise is. The 11-cent target is not just a randomly chosen figure. This target is obtained through specific measurements in technical analysis. According to Elliott wave principles, the third wave is usually 1.618 times the length of the first wave or more. However, in a very strong market, this ratio can increase further, reaching as high as the 2.272 level. In this case, when the current price movement is calculated relative to the length of previous waves, it is expected that the price will reach 11 cents when the third wave hits this extension level. Reaching this level creates a significant shift in investor psychology, because at this point, many technical analysts and traders confirm the strength of the uptrend. The psychological effect of the third wave is also significant. Most market participants act on the principle of "the trend is my friend" during the third wave. This wave brings more positive headlines in the news, more social media posts about the coin or stock, and peak investor interest. In such an environment, FOMO, fear of missing out, kicks in, driving the price upwards even faster. This psychological effect is an important factor that, alongside technical analysis, accelerates the price toward a strong target like 11 cents. In addition, third waves that reach the 2.272 Fibonacci level generally indicate that the market is structurally strong. This means that the rise is not just a speculative move. Behind it, there are usually factors such as a strong fundamental story, high volume, institutional buying, or large investors entering the market. When these conditions are present, the probability of the price reaching the set targets becomes much higher. Therefore, the 11-cent target is not only a technical projection, but also a result supported by market dynamics. One of the most important aspects of Elliott wave theory is that each wave is made up of smaller subwaves. The third wave itself contains 5 smaller impulse waves. These subwaves maintain the direction of the main trend, allowing the price to climb steadily. If the third wave has extended to the 2.272 level, it means each of these subwaves has moved with strong momentum. This indicates a market dominated by buyers with weak selling pressure. Reaching 11 cents also lays the groundwork for the potential fourth and fifth waves in the future. This is because the fourth wave, which follows the third, is usually more sideways and a mild correction. This means that in the bigger picture, the price can reach even higher levels. In other words, the 11-cent target may not be an endpoint, but rather a midpoint in the rally. When this level is reached, many investors take profits, but as long as the trend continues, New buyers also enter the market. The extension of the third wave to the 2.272 Fibonacci level is one of the clearest examples of the technical definition of a strong trend. These types of moves are often harbingers of major rallies. As the price moves toward this target, there is an increase in volume, strengthening momentum indicators, and rising trend structures in oscillators like the RSI. When all these technical signals come together, investor confidence rises, and the market becomes even more active. In conclusion, if the third wave reaches the 2.272 Fibonacci extension level and carries the price to 11 cents, this is not only a technical achievement, but also proof of the market's structural strength. Such targets provided by Elliott wave theory play a critical role in shaping both the short-term strategies and long-term plans of investors. In such a scenario, patient investors can maximize their gains from this major wave movement.
The calculation here clearly and simply demonstrates the investment math showing the potential gain between the current XCN price and a set target price. First, the starting capital is set at $2,000. This $2,000 is divided by XCN's current price of $0.013. The result gives the amount of XCN that can be purchased with this capital. When we divide 2,000 by 0.013, we get approximately 153,856 XCN. This number represents the total amount of tokens the investor can buy right now. In other words, if the purchase is made today, the wallet will hold exactly 153,856 XCN. Now we get to the most exciting part. At this point, a target price has been set, $0.11. This target may have been determined through technical analysis, Elliott waves, other methods that study market behavior, or positive expectations about the project. If XCN reaches this $0.11 level, multiplying the total amount held by the target price will reveal the potential profit. Multiplying 153,856 XCN by $0.11 results in a figure of $16,923, which is quite a satisfying number. This means that the initial $2,000 investment would grow to about 8.46 times its original value. In other words, the capital would increase significantly if the scenario plays out. Multipliers like this boost the investor's motivation and strengthen expectations for the project. Especially with low-priced crypto assets, reaching target prices within a certain technical structure creates a high multiplier effect, which is one of the main factors attracting many investors. This is because the purchase price is kept low, while the target price is set well above the current price. This gap creates a strong profit potential. Of course, this calculation depends entirely on the set target price being reached. If XCN indeed reaches the $0.11 level based on market movements, investor interest, new developments, project updates, and general crypto market trends, the gain here would represent almost a 9-fold increase. However, another factor is the time frame in which this rise might occur. Sometimes it may take several months to reach such targets depending on market conditions, while during a bull season it can happen much faster. In Elliott wave theory, the third wave is known to be the strongest and longest wave. If earlier analyses predicted that the price could advance to the 2.272 Fibonacci extension level and reach $0.11, then this target price is technically supported as well. In such a case, the 153,856 XCN held by the investor would become a highly valuable portfolio once the price reaches this level. At this point, the investor would not only have made a strategically sound entry, but also reinforced their motivation by calculating the potential profit in advance. Such potential gains can also affect the investor's future plans. For example, turning an initial $2,000 into $16,923 is not just a numerical increase, but also an important step toward financial freedom. The profit earned could be reinvested in other opportunities, used to build larger portfolios, or fully converted into cash to meet personal goals. In such a scenario, it becomes clear how much of a strategic advantage the initial low-cost purchase has provided. In addition, calculations like this create a clear vision in the investor's mind. Knowing in advance when and at what price level to sell helps prevent emotional decisions. One of the most common issues in the crypto market is becoming greedy as prices rise or panic selling when they fall. However, since the target price here is clearly set in advance, the investor can rationally sell and realize the profit when that level is reached. Another important factor for investors is how long the capital will be tied up. If XCN reaches this target in a short time, the rate of return, measured annually, would be extraordinary. However, it is also possible for this process to take longer. Still, given the size of the potential return, the wait may remain attractive to the investor. The critical factor here is being patient and consistently following the target set in technical analysis. This calculation also clearly shows the risk-reward balance for the investor. With a $2,000 investment, potentially earning $16,923 offers a high return potential, but also carries the risk of losing the initial capital. Risk always exists in the crypto market, and the key is to manage it properly. If the investor enters this position only with capital they can afford to lose, the risk perception is balanced. In this case, even if the price does not reach the desired level, the investor can act more comfortably from a psychological standpoint. In conclusion, this potential profit calculation for a $2,000 XCN purchase shows how strong a leverage effect an investment can create. The fact that the current price is quite low and the target price is set far above the current level are the main factors that make this investment attractive. In such a strategy, the investor has the chance to multiply the initial capital both through technical analysis and the discipline of patiently waiting. Especially since the target price is supported by strong technical analysis methods like Elliott waves, this scenario becomes even more likely. Therefore, if the investment plan is clear, the target is set, and the strategy is applied with discipline, this initial $2,000 could turn into a satisfying $16,923 in the future.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.